Now let's start with the P10-10 because I was not able to take this up in the afternoon classes because of the brownout. So anyway, morning classes, please bear with us. So again, the requirements, we have 6. Number 1, compute the number of cans of each kind of nut sold. Now we have 3 types of nuts: almonds, cassoys, and walnuts. 10,000 cans of nuts were sold, and the amount of walnuts sold were twice as much as the number of cans of cassoys, whereas almond sales were one half of the amount of cassoy sales. Fixed costs were 40,000, and the unit sales prices and the unit variable cost were as follows. So to compute for the number of cans of each kind of nut sold, we have to begin with the algebraic equation here. Let x equals the cans of kasoy sold, and walnuts is 2x, almonds 0.5x. So we have now the sum of 10,000 cans. The breakdown is x plus 2x plus 0.5x equals 10,000. So the sum of 3.5x equals 10,000. X equals 2,857 cans of kasoys, and almonds sell only at zero point 0.5 of kasoys, so 1429, and walnuts we have twice as many as that of kasoy, so 5, 7, 14, the total of 10,000 cans. Compute the sales mix percentages. So for the 3 products, then we have the unit sales computed in number 1, and each unit sales divided by 10,000. So for almonds, 14.29%. So it means that in selling 10,000 cans, 14.29 of 10,000 is sales of almonds, 28.7 for cassoys, and walnuts, 57.14%, a total of 100%. Then we go to number 3, compute for the weighted average contribution margin per unit. So the weighted average contribution margin per unit is computed by adding almonds unit contribution margin times cans sold almonds. Then we add kasoy's unit contribution times cans of kasoy sold, plus walnuts unit contribution times walnuts sold, or the number of cans of walnuts sold. So we have now the total in the numerator divided by the denominator, almonds sold plus cassoys and walnuts. So for the numerator, computing now for the contribution margin of almonds, 8 minus 4 times number of cans of almonds, 10 minus 5 for cassoys, multiplied by the number of cans, and 6 minus 4 for walnuts, contribution margin times the number of cans. And we divide this by the total of 10,000 cans with the corresponding breakdown. Okay, so we now have 3.143 dollars. That's your weighted average contribution margin per unit. Now, number 4, compute for the overall break-even sales in units. So we have now the formula fixed cost divided by weighted average unit contribution margin. Finally, 40,000 divided by 3.143 or 12,727. That's the break-even sales in units. So to be allocated in the proportion computed in number 2, so we have now a total of 12,727. Next, in number 6, we have to compute the break-even dollar sales of the three products. So for number 5, compute the unit sales of almonds, cashews, and walnuts at the break-even point, where the break-even point in number 4 is 12,727. So again, using the percentages, in number 2, we have now the total cans sold at 12,727. And the break-even dollar sales, we now multiply the break-even unit sales times the unit sales price. So we have the given unit sales prices in the problem. Next, we go to problem 10 dash. Anyway, I'll just include 10 dash 11. 10-11, the requirements are number 1, if the unit sales price is $2, how many units must be sold to break even? Now the hint, first compute the variable cost per unit. So the Emerald Island Company is considering building a manufacturing plant in County Kerry, predicting sales of 100,000 units. Emerald Isle estimates the following expenses. So we have now the total annual expenses for actually cost and expenses for materials, labor, and overhead for the total of marketing and administration. Then we have the percent of total annual expenses that are fixed. So for materials, only 10% is fixed. For labor, 20%. For overhead, 40%. And marketing and administration, 60%. An Irish firm specializes in marketing will be engaged to sell the manufactured product and will receive a commission of 10% of the sales price. None of the U.S. Home Office expense will be allocated to the Irish facility. So in the case of number 1, we have now your total expenses given at 119,000. Actually, we have materials, 19, labor, 26, overhead, 40,000, marketing and administration, 14,000, and the commission is 100,000 units times $2 per unit times 10%. So the commission of 20,000 for the predicted sales of 100,000 units. So the percent fixed given, of course, commission is purely variable. Now we have the fixed expenses for materials 1,900, labor 5,200, overhead 16,000, and marketing and administration 8,400. The total fixed of 31,500. So the excess, you have the percent variable for materials 90, for labor 80, for overhead 60, and for marketing and administration 40. Now computing for the variable expenses, 31 500 for the fixed and the variable expenses including commission of 87,500. So that gives us the total of 119,000. Now, 87,500 for the variable expense divided by 100,000 units. The variable cost is 0.875 cents. So, dividing now the fixed cost by 2, the sales price minus 0.875, the variable cost rate. So we now have 1.125, the contribution margin. So the break even in units of 28,000. That's now in units. Number 2, calculate the margin of safety ratio. 100,000 units minus 28,000 units. That's your break-even point divided by 100,000. So we have now your margin of safety ratio equals 72%. The contribution margin ratio, $2 is sales, 0.875 your unit variable cost. So we have the difference of 1.125 and we divide it by $2. So that gives us the contribution margin ratio of 56.25%. Now we go to 10-12. Actually, 10-12 has 4 requirements. And the first one, what amount of pre-tax income is needed to earn an after-tax income of 500,000? So after-tax income. Pre-tax income if is after tax income divided by 1 minus the tax rate. So the after-tax income of $500,000 divided by 1 minus the tax rate of 40%. 40%. So that gives us the result, a pre-tax income of $833,333. So it means that your 333, that's your net income before tax. So you deduct the tax of 333.33, that's at 40% of the pre-tax amount. So the after-tax income of 500,000. In number 2, what target volume sales revenue must be reached to earn the 500 after-tax income? So the target volume in dollars, the fixed cost plus the pre-tax income divided by the contribution margin ratio. So you have now the fixed cost of 2.5 million is given plus the pre-tax income computed in number 1 and we divide it by 300. That's your selling price and the unit variable cost of 150 divided by 300. So 300 minus 150, the variable cost, the difference of 150 is also the contribution margin. Now, the contribution margin. And we now have the difference of the ratio of 300 minus 150 or 150 divided by 300. That's your contribution margin ratio. So we now have your amount of 2,500,000 plus 833.333, and that's for your numerator divided by the CM ratio, that's equal to zero point 0.5. So you have now your target volume dollars of 6,666.67 supposed to be, but we have rounded off. Now in number 3, assuming that this is a single product firm, how many units must be sold to earn the after-tax income of 500,000? So how many units? The target volume in number 3, that's the requirement. Fixed cost plus the pre-tax income divided by the unit contribution margin. We now get the total divided by 150, the unit CM. So the result is 22,222. That's the target volume in units. Now the target volume in dollars, fixed cost plus net income as stated, 500,000 divided by the contribution margin ratio, and so we have 6 million. That's the target volume in dollars. Okay, now we skip 10-13. We will take this up together with the differential costing. Now we have 10, 15 R. This is a comprehensive review problem involving break-even point, absorption, and variable analysis. The company has a maximum productive capacity of 210,000 units per year. Normal capacity is 180,000 units per year. Standard variable manufacturing costs are 10 per unit. Fixed factory overhead is $360,000 per year. Variable selling expense is $5 per unit, and fixed selling expense is $252,000 per year. The unit sales price is $20. The operating results for the year are as follows: sales 150,000 units, production 160,000 units, beginning inventory 10,000 units. All variances are written off as additions to or deductions from the standard cost of sales. What is the break-even point expressed in sales dollars? So we have now the break-even point computation for sales volume. Fixed cost equals 360,000. We are now given the amount of 360,000 for fixed factory overhead and fixed selling expense of 252,000 divided by 1 minus the variable cost over sales. So we now have the 360,000 numerator plus 252,000 we have divided by 1 minus 10 plus 5 divided by 20. So 10 plus 5 divided by 20. 10 is a variable manufacturing cost. 5 is the per unit. So we have now per unit variable selling, and 20 is the sales price. So we now get the result, adding 360,000 by 252,000, or 612,000 divided by 1 minus 0.75. Now 0.75 is the result of dividing 15 by 20. 15 is the sum of 10 and 5 divided by 20, so we get 0.75. 612,000 divided by 0.25, then we have 2,448,000. That's the break-even sales volume. Then in number 2, how many units must be sold to earn a net operating income of $100,000 per year? So we have now fixed cost plus net operating income divided by the unit sales price minus the variable cost per unit. So we have the fixed cost of 612,000 and net operating income of 100,000 divided by unit sales price of 20 minus the variable cost per unit of 15. So we have 5. Now the answer, 142,400 units. And in number 3, prepare a formal income statement for the year ended December 31, 2016. 20 in number 3. So we have now under the following A, absorption costing, and hint, don't forget to compute the over or under applied overhead, and B, variable costing. So we now go back to absorption and variable costing. Sales, 150,000 units times 20 equals 3 million. And then we have now your cost of goods sold. Cost of goods sold. The beginning inventory is 10,000 units. Given 10,000 units for the unit cost of 12. So we now have the beginning inventory given. So now we have 10,000 units, and the unit cost is 12. Standard cost of production is equal to the variable cost per unit of 10. Per unit 10, and then we add the fixed cost per unit 360,000 divided by the production of 180,000 units. So that gives us a unit cost equal to $2. So we now have the unit cost equals the sum of the variable cost plus um, the fixed cost. And by the way, the fixed cost per unit is computed based on the normal capacity. Initially, it's already computed based on normal capacity and not based on actual capacity. So the fixed standard siya eh. We are talking about standard cost of production. So we use the fixed factory overhead rate based on the normal capacity, and that is $2. So we now get the variable cost per unit of 10 and the fixed cost of 2. That's why we have the beginning inventories cost equal to 120,000. Then we add the cost of goods manufactured during the period the company's production is 160,000 units times 12. The goods available for sale is 2,040,000. We deduct the ending inventory of 20,000 units. So the ending inventory of 20,000 units, you multiply by the unit cost. So we have now the ending inventory computed as follows. Beginning inventory 10,000. Then we have the production of 160,000. The total inventory available for sale is 170,000. And then given is the unit sales of 150,000. So meaning we have the ending inventory of 20,000 units. So here we have your goods available for sale. We deduct the ending inventory of 240,000. That's 20,000 units at 12. Then we have the cost of goods sold at standard, and we add the underapplied fixed factory overhead of 40,000. We have the adjusted amount of cost of goods sold of 1,840,000 for the cost of goods sold. Now, how did we compute for the underapplied fixed factory overhead? The underapplied fixed factory overhead is the fixed factory overhead is 360,000. We applied based on the units produced 320,000. That is $2. So we have the underapplied of 40,000 because the applied is lower than the budget. So we now get 40,000 under applied fixed factory overhead. It's treated as an addition to cost of goods sold at standard. So the under applied fixed factory overhead of $40,000. So then we have from sales minus cost of goods sold. We now get the gross margin on sales. Then we deduct the selling expenses variable at $5 based on units sold. And we have the fixed of 252,000. Total, we have to deduct from 1,160,000. The difference is net operating income equal to 158,000. That is by using full or absorption costing. Now, the second one is based on variable costing. Based on variable costing. Here, the variable costing income statement. Again, we have sales of 3 million. The beginning inventory is 10 times 10. So we only include the variable cost, the variable manufacturing cost. That's at 10. So we now get 100,000. Cost of goods manufactured at 10. Goods available for sale, 1.7 million. Then we deduct the ending inventory at 10, the variable manufacturing cost of goods sold. Then we have the variable selling expense at 5. It's given here, 150,000 is the number of units sold. And we have the variable cost of 10. So we now get the ending inventory at 10. 200,000, the variable manufacturing cost of goods sold. And we have now your variable selling expense at 5 based on the number of units sold. So we have 757,000. We now get 2,250,000. That's your total variable cost and expenses. So from sales, we deduct 2,250,000. The difference is contribution margin. Then we deduct fixed factory overhead and fixed selling. Then the difference is net operating income. Net operating income under the second method of costing, no? Absorption is the first one, and then the second one is variable costing. The net income is 138,000. Under the other method, the net income is 158,000. Now, if ever you will be recognizing the difference, net operating income 158, and here we have net operating income equal to 38. 138 minus the operating income of 158,000. Here 158,000 for absorption costing, and we have now for variable costing. The difference between 158 and 138, we have now your inventory at the unit price. We have, it's either the variable costing method is used or the absorption costing method. So we have now the requirements in 10-15R. Now I'll proceed to the mini case number 1. The mini case number 1 is, by the way, we have the comparison here. That's variable costing method, and okay, followed by mini case number 1. Mini case number 1 has 4 here. We have 4 requirements. Now this case is related to absorption and variable costing. Okay, now in question number 1, if sales only reach 450,000 units for the year, how many additional units would have to be produced given the current selling price and cost structure to meet the budgeted profit of 2.2 million? So we are now dealing with a fixed absorption costing. The board directors of Mesa Verde Tool Company set the profit goal for calendar year at 2.2 million. That's target goal. It also established a bonus plan in which the top 5 officers of the company will share 150,000 if the profit goal is met or exceeded. If the goal is not met, there's no bonus. TJ Elias, the Chief Financial Officer and one of the top 5 executives, prepared the following budgeted income statement based on the board's profit directive. So we have now the given budgeted income statement with its sales and the cost of goods sold for 8 million. So we now get the gross margin of 7 million, selling and administrative expenses, variable selling and administrative 52,800,000. Fixed is 2.2 million. So the total variable and selling and admin expense is 4.8 million. So we now add the two, that will give us net operating income of 2.2 million. In the case of requirement number 1, as we move further, by late September 1, it became apparent that sales were running below forecast and that annual sales would approximate 450,000 units for an estimated net income of 1,230,000 and no bonus. In an executive committee strategy meeting, Bob Ronchell, Vice President of Manufacturing, suggested that the production capacity was available to produce the entire 500,000 units or more, even if that sales level could not be reached. He remembered a presenter from a seminar that he recently attended describing how net income could be increased by producing more than can be sold. Okay, he urged Elias to determine how many units, maybe how many extra units they would need to produce or to achieve the profit goal and thus earn. Okay, so if sales only reach 450,000 units for the year, how many additional units would have to be produced given the current selling price and cost structure to meet the budgeted profit of 2.2 million? Prepare an absorption costing income statement to prove your answer above. What ethical responsibility, if any, does Elias have in this situation? So we now begin with the requirement number 1, and it is the cost to meet the budgeted profit. How many additional units would have to be produced? Since the fixed factory overhead of 5.5 million, that's the fixed factory overhead. We now look at 5.5 million. Since this amount of 5.5 million here is the only expense that can be manipulated to meet the profit goal, let X equals the maximum amount of fixed factory overhead that can be released to cost of goods sold while reaching the profit goal of 2.2 million. So the fixed factory overhead supposed to be, it's included as part of the cost of goods manufactured. That's the variable manufacturing, 500,000 units at 5, and the fixed manufacturing of 5.5 million, while the variable is 2.5 manufacturing at 500,000 units. So we now begin with sales, 450,000 units at 30. That's the unit selling price given at 30, taken by dividing 15 million by 500,000. So that's equal to 30. Factory overhead fixed is the only expense that can be manipulated to meet the profit goal. Let S equals the maximum amount of fixed factory overhead that can be released to cost of goods sold while still reaching the profit goal of 2.2 million. Now we have sales 450,000 units at 30. So we now get the result for sales of 30, 15 million divided by 500,000 units. So the selling price is 30. Then we have the variable manufacturing cost, 450,000 units at 5. The variable manufacturing cost is here we have the variable manufacturing cost included in your cost of goods manufactured here. The variable manufacturing units, 500,000 units at 5 per unit. So that's why sometimes we have this to multiply here 500,000 units at 5, 2.5 million. The fixed manufacturing overhead is 5.5 million. So we have the variable manufacturing cost, 450 million times 5 given rate, variable selling and admin. Given rate is 5.60, variable selling and admin. So you have 2.8 divided by the number of units sold. That's here we have the unit manufacturing cost, which is 5. Then the variable selling and administrative cost at 560. Fixed selling and administrative cost of 2 million. Okay, so we have now your total. Then the target profit is 2,200,000. Fixed factory overhead expense is 4,530,000. So 2.8 million divided by 500,000. That's your 5.60, the variable selling and admin. The fixed factory overhead expense equals fixed factory overhead held back in inventory to meet profit goals. So 5.5 million minus 4,530,000 equals $970,000. Then the additional units needed to be producing fixed factory overhead held back over fixed factory overhead per unit equals 970,000 times 11, computed by dividing 5,500 by 2. Okay, so we now get the fixed factory overhead held back divided by fixed factory overhead per unit. So we now get 970,000. Then we divide that by 11. So we have 5,500,000 over 500,000. Now you are going to get then the units. And finally, we have the per unit. Okay, that's 11. And in requirement number 2, prepare an absorption costing income statement to prove your answer. So you have sales, beginning inventory 0, cost of goods manufactured, then we have the total goods available for sale. We deduct the ending inventory equals cost of goods sold. And then from the cost of goods sold, we are now going to have 8,190,000. That's your budgeted income statement. So 8,190,000 19, no? We are already answering variable manufacturing cost, and we have the fixed manufacturing cost, the difference of 8,190,000. Then we have the variable cost in inventory, 440,910. Fixed cost held back in inventory of 970,000. So finally, for question number 3, what ethical responsibility, if any, does Elias have in this situation? So remember, responsibility in the credibility section of the IMA's Statement of Ethical Professional Practice that most applies to this is disclose all relevant information that could be approved. Disclose. So the word is disclose. Okay, now we have to disclose all relevant information that could reasonably be expected to influence an intended user's understanding of the report's analysis or recommendations. There's no reason other than the desire for the bonus to produce the additional 88 and 100 here 88,182 units. In fact, producing those additional units will increase inventory. Okay, so we have now the inventory's cost, like ordering and carrying cost. It's the responsibility of here Elias to not agree to the production of the additional units. Okay, so it is Elias' responsibility to not agree to the production of the additional units. If necessary, should go to the CEO or the board directors to prevent such action. The problem in the case of number 4, the problem with the bonus plan is that it is all or nothing. Okay, so it's all or nothing based on hitting a certain number. Perhaps the company should consider varying amounts depending upon what level of point be achieved. Okay, so these are the problems that we need to discuss. For tomorrow, I have already given the problems that you have to solve for tomorrow. We have 10-E10-15. Accept, reject, special orders. So accept or you reject. Okay. Now, see you tomorrow for the rest of the problems that we are going to discuss. Okay? So, ano?